Kirk Marley, Dovetail Planning, and I'm going to talk about net amount at risk right now, which is it's a universal life type of jargon. But universal life is it's a permanent life insurance product. It's not term. It's permanent, but it really depends on how that policy is structured. And so oftentimes people will come to me and they'll say, I want to make sure that I don't overpay for my insurance. So consequently, I don't want any cash value of my universal life contract, but I want it to last until I pass away. And there are contracts out there that can do that on a guaranteed basis. The guaranteed contracts are more expensive than a traditional universal life contract. And so I want to explain net amount at risk, because this is something you have to understand when you own a universal life contract. There are monthly deductions that come out of universal life contracts. It's not like whole life. It's more like a term contract where the mortality charge, which is the cost of the death benefit, is paid on a monthly basis out of the cash value of the contract. And what that cost is, it represents what is called the net amount at risk. So let's say you have a $250,000 death benefit and you have $100,000 of cash value. The cost inside the policy, the net amount at risk, is the $150,000. Even though you have a $250,000 policy, $100,000 is cash value, and the company already has that to pay your eventual death benefit. So there's no risk for them, and they're not charging you for that. And so the problem with underfunding contracts is as you get older, the cost per $1,000 of insurance goes like this. And if your cash value is going down, you're buying more and more of that net amount at risk, and your policy does fail. It will not be around when you die. And that's just my experience. But that really is the way that it works. And that's the problem also sometimes with variable contracts, is variable contracts are amazing. When the market is going up, you're doing really well. But if you have a correction like we did in 2008, where you're talking about 40 or 50% reduction, in your cash value, because the market went down that much, then not only do you have to, if you have a 50% loss in your value, you've got to have 100% return to get back up to where you were, right? In order to double, it's got to be 100% return. All the while, your expenses have gone straight through the roof too, because your net amount at risk has gone way up. And there are riders and things you can put on variable contracts that help reduce that possibility, but they cost something. So anyway, remember, net amount at risk, that's an important concept. There's all kinds of parts of a universal life contract that are not spoken about, but that have a direct impact on the viability of that contract.